Hello everyone, welcome. So I will be talking today about the market internals and how to become a smarter trader using the ADD and tick. And this is mainly uses for SPY, SPX, ES, and QQQs. Those work the best, and you understand why that's important when I'm explaining to you what those things are. But before I start the presentation, I just wanted to remind you I'm not a financial advisor and this video shouldn't be taken as a financial advice. With that being said, let's start the video. Okay. Let's first start talking about what market internals are, right? Market internals are indicators that traders can use to get a sense of trend, direction the market is going. The most used market internals are the ADD and tick. We're gonna get more in detail which each of those are later in the video. And the main reason people love using those and why I decided to understand a little bit more about what market internals are is because we all know that the EMAs, the MACD, the TTM squeeze, the RSI, and all the other indicators, they rely on the underlying stock price. The ADD is not, and tick is not based on the stock price. The underlying stock price is not based in only SPY, it's not based in only Apple, it's not based only in Tesla. The internals are based in across all the stocks on the New York Exchange. So what that means is, let's start with the ADD, advanced decline line. So just see like this. The ADD will track how many stocks are trading above or below the previous close, the day close. And as I mentioned earlier, it will help you to understand if we are trading in an uptrend, downtrend, and also chop day. Let's go into a few examples so you can understand how you can identify that. As you can see, I have the ADD, and I also put some lines to help me to understand when it's going to be a downtrend, uptrend, and the choppy. If you use thinkorswim, just do the $ and ADD. That's the tick you need to find. And as you can see here, the zero mark is going to be if you're below the zero mark, this is showing you that most of stocks on the New York Exchange is trading below the previous day close. So as you can see, so this is a sign of downtrend. Same thing goes when you're trading above the zero mark. The higher you go, the stronger the uptrend is gonna be. Same thing for the downside. When you see ADD trading between the 1500 and 2000, that just showed to you that the uptrend is really strong. And as I mentioned, the same thing goes for the downtrend. Now let's go to the example that you can see the choppiness. How we can identify as a choppiness. When you see SPY not moving much and people go, why, what is going on? ADD is gonna show you that most of stocks are trading between the previous day close. When you see like this around zero, that just means you're probably gonna have a chop day, and helps you to maybe don't trade, maybe secure your capital. But keep in mind, if you see ADD just around, it doesn't mean that this cannot shot up right here and start making uptrend. Most of stocks are trading up. That can happen. The same thing goes if it's trading below zero. It doesn't mean cannot cross zero and then start to make an uptrend. This all can happen. So next, let's go a little bit about tick, which is my favorite one to use. So tick compare the total of stocks that are moving up tick, and down tick. So this means that in a green candle and in a red candle. And the difference between tick and ADD is that tick is independent of the previous day's close. So what does that mean? That is based on what is happening on that specific time. I like to use 1 minute. So when you see tick going down, red, that means that most stocks on the New York Exchange are trading a red candle. So basically it compares to the previous candle, not previous day. So it's a stronger and faster indicator. And it's important to mention that this is not related to anything that will happen a swing or intraday swing. This is in a short term based. I like to use 1 minute to help me to find my entries and my exits. So it doesn't mean when you see tick going trading red, and you understand better when I show you some examples, that we're gonna dump all the way like 50 points on SPX. So that can only mean that we're just having a pullback. You need to understand and identify the trend and what is happening in the overall market, right? Which is why I like to use both, but tick is the mainly I like to use. So now let's go to some examples, right? Tick is also in a way you can help you to identify trend. But let me just tell you guys, if you guys you're gonna start using tick, the same thing on Thinkorswim, you can just do $ and type tick. Make sure you plot those lines. Those are extreme zones where you're gonna find exhaustion. You're gonna have the zero mark, which is gonna be is not trading up or down from the previous candle. And then you're gonna have this plus 600, plus 800, plus 1000, negative 600, negative 800, and negative 1000. When you see around those extremes, that means you're gonna have a exhaustion move. So that means you're gonna have a pullback or a bounce. But again, remember, this is a short-term indicator. Doesn't mean you're gonna have a bounce to not make a new high of the day. It just means maybe in an uptrend, right? Like this is you're seeing that it's basically going up, touch zero, and then goes up again. That's on a trending market is the best way to use. You don't need to wait to go all the way to the negative extremes to getting calls. Just wait to the zero mark and then you can get the bounce. So when you see that most of the candles are closing above zero, as you can see on the first example here, that means showing to you that we have in an uptrend, at least in this short-term period, because this can flip to become bearish. Same thing goes to the downside. When you see tick trading below zero, that means you're having a downtrend. And again, at least on the short term. As you can see, this time frame here is from 11 a.m. to 12:30 p.m. So on this time, we are trading down. And the way to use this to trade is just waiting to bounce from zero. So you see that every time touch zero, you have a bounce. Every time touch zero, you have a bounce. Same thing on the downside. Every time you go to zero, you have a pullback. Every touch zero, boom, extremes. And so on. Why this can be useful for your entries and your exits. Let's say in an uptrend, right? And then you got in calls, and then you're riding up, and then you see we're going up, 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 and then you see tick touching extremes. I personally like to exit my scalps. Why? Oh, but why you don't just wait for the pullback and then you can ride again? I like to lock my profits, wait for the pullback, which I like to call tick the cool off. You see tick cooling off, the exhaust move, and then I can get back in. That's how I use it. And same thing goes to the downside. Now let's go to the range bound market. The range bound market is where a lot of people struggle and a lot of people lose money. Even if they get in the right side of the trade, they still lose because they had a bad entry and they end up selling for a loss. Different than the trend day, which is the easiest, range bound is where it gets difficult. You see the chart going all those like crazy move ups and then dump, crazy move up and dump. And the same thing you're gonna see on tick. You see going from the low extremes to the high extremes in really short period of time. You see here from 315 to around 320, boom, boom. So the right way to use when you're in the range bound market is to wait tick to touch the extremes, and then you play the what side you're gonna find. So we all know that in a range bound market you're gonna have levels, right? And you're gonna have let's say you're gonna see SPY trading between 410 and 48. Whenever it goes to 410, you see a sell. Whenever it goes to 48, you see a people buying. So wait for those extremes to show up inside this range, and then you use. If you're in a demand zone and tick is on the low extremes and the exhaustion move to the downside, that's a good setup to gain calls. And then the same thing goes when you get to a supply zone or resistance area, whatever you'd like to call, and tick is on the extremes. Just wait, find the right time, and then you get into short. Now I'm gonna explain the best and the most efficient way that you can trade and use in both of those conditions, on trend in the range bound day, which is the divergences. And this is my favorite. As you can see here on the chart, I plotted this supply zone, which is the high of the day, and I plot this demand zone, which was the low of the day. How you can use the divergence, just like you use the divergences on RSI and all the indicators. You can see this gray line, which shows you 10:57 a.m. is the same gray line, 10:57 a.m. on this candle. As you can see, you make this lower low and this higher low. This is a bullish divergence. You see SPY going down, but most of the stocks are not sustaining this move down. So, and you're aware in a demand zone. So when you find these levels and you find those divergences, this is an A+ setup where you can get in calls. It doesn't mean it's gonna work in your way, but your risk reward is gonna be great, where you can get in calls, have a stop loss below this demand zone. I don't like to put in this lower. Why? Because you can just get here and they're wicked up. So I like to put a little bit lower, and then you see this divergence, and then you go in calls, go long, and look all this move. You can have moved from 393 all the way to 396. And if you look back in the trading day, I can show you more divergence. Just look this 1130 right here. This right here, right? 1130 right here. This high is the same high than this. This high is the same high than this. You see going up and going down. This is a bearish divergence. Look at the pullback. And then you went all the way to extremes right here, touching the EMAs. Look at that nice setup. You can get in calls and look again. Boom. You will find these divergences in all day long in every single trading day. That's why I like to use the divergence in the best is my favorite way to use. And I would recommend people to be looking for those every day, regardless if it is on the uptrend day, downtrend day, range bound day, whatever it is. It's a great tool to scalp and help me a lot in entries and exits. When you're patient and you're waiting for those perfect divergences or touching the extremes, the exhausted moves, that teaches you a little bit more to be patient to find a better entry. I hope that helps, and you guys have a great day. Drop comments below if you have any questions. Thank you. Bye bye.